Joining us now around the table is Stephen Brown, CIO of Fixed Income at Guggenheim, and Ed Al-Husseini, Global Rate Strategist at Columbia Threadneedle. And I'll start with you, Ed, here. No one was really expecting any meaningful fireworks out of this Fed meeting, but I am curious, when you think about what he didn't say or what they didn't do today, did that actually send a broader signal?
You know, largely, the Fed is reaffirming the messages they've given us in the first 6 months of this year. I think what they didn't say is really articulating a path towards higher rates. And I think that's really important, right? That underscores the fact that the next move is going to be a cut. And that really is a departure from where we were at the beginning of the year.
Does that sound to you as something that I guess can be interpreted as dovish? Sorry, Steve.
Oh, sure. Yes, it does. I mean, as Ed said, they've been signaling basically to ignore the inflation data for now because it's either a lagging indicator or has the potential to change. The one thing that could make the Fed move quicker would be a weakening of the labor market. But as Ed said, the important thing to note as bond investors and credit investors is the next move is still going to be lower rates.
I am curious, Steve, when we talk about this idea of the next move, and if it is lower, and you have a market that, at least right now, seems to be relatively in sync with what's on that dot plot and what's being communicated. But when you hear comments by Governor Waller a little bit earlier on CNBC, this idea here that there are some members of the Fed that do appear to maybe want to move a little bit sooner than what was telegraphed out of the Jay Powell press conference, is that something that investors should at least maybe be more mindful of?
I think so, and as you let off the show, there's going to be more speaking post the Fed meeting in the coming weeks. They've done a very good job of communicating to the market well in advance of essentially telegraphing what they're going to do at each meeting. So that probably won't change much for July, but really how we're thinking about it is September is very much on the table and is really a live meeting. By then you will have had more of a read-through on the inflation data and the tariff impact or not. You'll have a few more months of employment data. And then, importantly, that'll give the Fed the potential to actually act on data rather than choosing to look through it as they are for now.
So, Ed, this gets us into that parlor game. And when we start talking about inflation, whether it's going to appear, if it does appear, whether it's going to be transitory, we've kind of been there before. What evidence is there that the impact from tariffs and some of the other policy decisions out of Washington are going to have a meaningful impact on the economy, at least meaningful enough that it would require some sort of Fed action?
Yeah, I mean, I think the good news from the Fed's perspective is that the labor market right now is a big dampener. It dampens out the effect of the tariffs, and look, we're in the early stages of that. And it's likely to dampen out the stimulative effect of the tax policy changes that are in the pipeline as well. And that really goes back to how different the environment is today versus where we were in 2022 when the labor market was an accelerant. It broadened out the inflation story. It made it a lot more persistent. Those factors aren't in play today. And I think that keeps alive the possibility that the Fed's going to cut as early as this year.
There was something interesting Powell said at the press conference about the labor market, Ed. He basically said, look, if you are out of a job right now, you're probably having a rough time finding one. But if you have a job, at least in Jay Powell's view, there aren't really mass layoffs. There isn't any material risk at the moment that you're going to lose that job. Is that a healthy labor market?
It's not that great in the sense that the buffers are really, really thin, right? If the pace of labor creation slows, right? If we're hiring at a slower pace, maybe below 100K or so a month, that unemployment rate could start to go up. And when it does, it starts to feed on itself. And that's a dynamic the Fed is really trying to avoid. So that buffer today is much narrower than it's been over the course of the past 3 years.
So, Steve, I'm curious that when you look at where Treasury rates are right now and what's being priced in, there's been a lot of talk, particularly on the longer end of the curve. So take from 10-year on out. The idea that of whether investors are being compensated enough for going that far out in duration. And I know there's still a lot of uncertainty out there, but when you look at those numbers on a 10-year or on a 30-year, is that attractive to you?
The 10-year is relatively attractive here, closer to 4.5%. I think you're going to continue to see more volatility and higher term premia expected by the market further out the curve. So as the 30-year, if that were to get above 5% again, that would be more interesting. Our positioning and bias has really been more towards the belly of the curve. That's where you're seeing a lot less volatility. And with a relatively flat yield curve still, and with the direction for short-term interest rates likely lower and potentially meaningfully lower, that's more of a sweet spot for us when it comes to interest rate positioning.
Ed, do you feel the same way?
Yeah, I think we're in the same boat. And largely, when you think about the longer end of the curve, we're looking for circuit breakers. And there's sort of two on the horizon. One is a more meaningful weakening in the labor market. The second piece is the Treasury changing the dynamics around supply. If the Treasury comes out later this year and gives us a better sense of whether they're going to be issuing closer to the front end of the curve, issuing more T-bills relative to longer coupon securities, that's going to be a phenomenal set of factors that set a ceiling on the 30-year.
It was kind of interesting. We got some interesting data, Stephen, when we talk about foreign buyers of treasuries. And I know there was a lot of talk that there would be some sort of buyer strike. There was obviously a lot of ructions in early April that at least the media seemed to place on the shoulders of selling by China and other big actors. Overall, though, the numbers really weren't that bad. Yes, there was a pullback by China, but that was clearly filled by other players out there. Is there any worry, given where rates are and given maybe the lack of premium, that we would see a material pullback in foreign buying?
There was certainly market worry, and as you led off the show with the data, arguably the most important release this week was the tick data. And the fact that while you did see minimal selling, it was mostly from private institutions and not from public institutions. So we're going to keep an eye on it, of course, and it is an overhang, if you will. But we weren't expecting to see the data showing that, because when we were going through the market experience at that time, we weren't seeing it. We weren't seeing it in our client base and our franchise base. So, and as you also articulated, higher interest rates here in the U.S. relative to other parts of the world, and the net need for investment products. You know, the U.S. is still the #1 place to be.
So overall, in your view, Stephen, you think the Treasury market, really overall, bond markets overall, are functioning properly, or at least as properly as we can expect?
Outside of a couple days in early April where there were significant dislocations in the funding markets, you saw moves in swap spreads, for example, that were abnormal, and you saw correlations breaking down between the level of the dollar, levels of interest rates, and volatility metrics. Outside of that, and that effectively caused the policy pivot, things have been functioning very normally.
I'd be remiss in not pointing out, Ed, this also happens to be kind of the anniversary, at least this week, of the big taper tantrum, when Ben Bernanke sort of stepped to that podium, basically said, yeah, we are indeed going to ease our quantitative easing. And of course, he had to walk that back a couple of months later. I guess it gets to the question, though, as to how much pressure the market could put on the Treasury and on the Fed should they be unsatisfied with the pace of change.
Yeah, it's a really difficult question. I think that exponential dynamic where the market sells off in an uncontrolled way, it's out there, right? That risk is always out there. I think our learning since the taper tantrum has been that we have the tools in order to cut that volatility and short-circuit that process very quickly. We've seen that dynamic play out in England in 2022, and the central banks today are much better equipped to deal with that sort of volatility than they were, 10 years ago.
All right, Ed, always appreciate talking to you, and Steve, and give my best to the folks out there out west at Guggenheim, Stephen Brown over at Guggenheim, Ed Al-Husseini of Columbia Threadneedle.